Florida's real estate market is unraveling faster than anyone expected, and the warning signs are no longer subtle.
Insurance is exploding, taxes are out of control, HOAs are drowning in debt, and major investors are packing their bags. This isn't a slowdown. It's the early stages of a full-scale market failure happening in real time. I've been investing for around 15 to 20 years. I've spent years studying real estate cycles and teaching investors how to spot cash flow traps before they wipe out portfolios. I've seen states go through these boom and bust cycles. Let me tell you something, the fundamentals will always win. And right now in Florida, the fundamentals are screaming danger, screaming. Now, before we dive deep into this, let me be frank with you. I'm not here to sugarcoat anything or tell you what you want to hear. I'm not going to do it. I'm here to tell you what you need to know. Florida's been one of the hottest markets in the country for years. People have been flocking there for the sunshine, the low taxes, and obviously the lifestyle. But the tide's turning, and it's not turning in a good way. It's not. And if you're holding Florida real estate, you need to understand exactly what's happening before it's way too late. So let's talk about how this bubble got created in the first place, because this didn't happen overnight. Like anything in real estate, it all comes down to supply and demand. Now, if you go back to 2020, around the pandemic, there were states that were winners and there were states that were losers. And Florida was the biggest winner of them all, the biggest. Open for business while other states locked down. No state income tax, beautiful weather, and it was the perfect storm for migration. 1.5 million people moved to Florida between 2020 and today. That's not normal growth, that's a stampede. And when you get that kind of migration, you know what happens? Supply and the demand equations, well, they go haywire. All these people moving in, they needed housing, but Florida's housing stock couldn't keep up. So prices, what did they do? They shot through the roof, right? Investors piled in there thinking this was the next gold rush, and then reality hit. Yeah, and it hit hard, didn't it? 2021 and 2022 brought inflation that we hadn't seen in 40 years. And then the Fed, what did they do? They jacked interest rates from basically 0 to over 5%. Suddenly that investment property you bought thinking you cash flow maybe $500 a month, well, it's now negative $1,000 a month. And that's when the exodus started. Not the regular people, they're emotionally attached to their homes. No, I'm talking about the investors, the cash flow investors, the ones who actually run the numbers. See, here's what most people don't understand. Cash flow investors are like the canary in the coal mine, if you will. When they start selling, that's your first warning sign. They don't care about the palm trees or the beaches. They don't. They care about one thing. Does this property make money? And right now in Florida, the answer is no. Just like in 2008, investors are the first ones out. They're taking losses, they're selling below market, and they're getting the heck out of there. Why? Because they know something the average homeowner doesn't. When a market turns, it can turn fast. And they'd rather take a 10% loss today than a 30% loss tomorrow. Now, if you're finding value in this wake-up call, hit that subscribe button. I drop the truth about real estate investing every week, and it could save you hundreds, if not hundreds of thousands of dollars. So let's break it down step by step, because what's happening in Florida right now, it's an absolute masterclass in how markets collapse. First up, insurance. And this one's a killer. Florida insurance premiums have doubled, if not tripled in some places. Some are up over 300%. And that's if you can even get insurance. We're talking $8,000 to $12,000 a year on top of what people used to pay just to insure a typical home. You see, every time someone files a claim for hurricane damage, every time there's a storm, who do you think pays for it? Yeah, you do. Yeah, you. The insurance companies spread those losses across every policyholder in Florida. So even if you're in Orlando and never see a hurricane, you're paying for the guy in Fort Myers who got hit. It's just how insurance works. And in Florida right now, well, everyone's paying for everyone else's disasters. And that brings us to problem number 2, property taxes. Local municipalities are hiking property taxes through the roof. Miami-Dade, Tampa, Orlando, they're all doing it. Why, I hear you say? Because somebody has to pay for the infrastructure for those 1.5 million new residents that I mentioned earlier. New roads, new schools, new water systems, new everything. Guess who gets the bill? Not the people who just moved there. No, it's the property owners always the property owners. This is already happening, and it's going to keep getting worse, I promise you. The state can't keep up with its growth, and the only way they know how to pay for it is through your property taxes. Now, expense number 3. And this one, well, this is a silent killer. It's the HOA problems. Homeowners Association. For those who don't know what it is, the Homeowners Association collect money to maintain the physical assets, the buildings, common areas, amenities. This gets charged equally among all the condo owners or homeowners in the development. The problem here is that most of these HOAs are managed by people who have no idea how to run a business, let alone manage real assets or real estate. They consistently underfund their reserve accounts because nobody wants to pay higher HOA fees. So when the major repairs are needed, new roofs, parking lot repairs, building maintenance, elevator replacements, they don't have enough dojo, they don't have the money. So what do? They hit the existing residents with special assessments. Now these special assessments are starting to roll in now, and they're making people absolutely furious. We're talking about surprise bills of $10,000 to $20,000, sometimes $50,000 or more per unit for major building repairs. You remember the Surfside building collapse? Remember that one? That was a direct result of underfunded HOA reserves. If they had properly funded the reserves and competent management, that tragedy probably never would have happened. Even the governor has stepped in with legislation to address this problem, but the damage, well, it's already been done. Properties across Florida are facing massive special assessments that are crushing property owners and investors alike. And what makes this even worse is the fact that these aren't one-time events. Once an HOA starts hitting residents with special assessments, it becomes a pattern because they never fix the underlying problem of underfunding. Think about this for a second, right? You buy a condo thinking your HOA fee covers maintenance and repairs. Then boom, you get hit with a $30,000 special assessment for a new roof. 6 months later, boom, another $15,000 for elevator repairs. A year after that, boom, $25,000 for building structural work. I've seen investors get hit with over $100,000 in special assessments in a single year on properties they thought were stable income producers. You getting it? Meanwhile, rents are flat or falling because of all of that inventory. Now, I don't know about you, but that's just a recipe for bankruptcy. And you can't refuse to pay these assessments. They can put a lien on your property. They can even foreclose on you in some cases and literally lock you out of your own unit until you pay up. Now, let's talk about the regulatory assault that's also hitting Florida investors, because this is where things get really ugly from a policy standpoint. You see, Florida recently passed legislation that restricts foreign ownership in certain markets. Now, whether you agree with that policy or not, what matters here is the signal it sends. The state is starting to pick winners and losers in the real estate game, and investors are increasingly being painted as the bad guys. But it doesn't even stop here. Local municipalities are implementing new regulations on short-term rentals, making it harder to maximize income from investment properties. Some areas are limiting the number of rental licenses that they'll issue. Others are imposing occupancy restrictions that just kill cash flow. You see, when governments start targeting real estate investors with hostile regulations, it's a clear sign that the political winds have shifted. And once that happens, it only gets worse, never better. Look at what happened in California. It started out with rent control in a few cities, and then it spread statewide. Then came just cause eviction laws, then tenant protection laws that made it nearly impossible to remove problem tenants. Each new regulation made it harder and more expensive to be a landlord. The smart money, well, it just gave up and left. Florida is walking down that exact same path right now. Now, here's where you should really start paying attention. Are you ready? You see, Wall Street sees things before retail investors do. They always have. Unfortunately, they always will. They've got teams of analysts and data folks that nobody else has. They have access, and most importantly, they have no emotional attachment to any market. Right now, they're dumping Florida real estate like it's radioactive. BlackRock, one of the biggest institutional buyers in the country, have quietly reduced their Florida holdings by 40% in the last 18 months. They're not announcing it. They're not making a big deal about it. They're just leaving. Private equity firms that were gobbling up single-family homes in 2021 and 2022, guess what? They've stopped buying. In fact, they're net sellers now. Yeah. These are the same firms that were outbidding regular buyers by 20 and 30% just only 2 years ago. What that tells me is that the smart money knows something the average investor doesn't. They've run the numbers and the numbers don't work anymore. And when you factor in the true cost of ownership in Florida right now, there's no path to profitability. None. They've run the numbers on insurance increases, they've modeled out property tax trajectories, and they've calculated the probability of special assessments. The conclusion: get out now while there's still buyers. And do you know who the buyers are? Who's buying these properties from Wall Street? Yeah, regular investors who still believe the Florida dream. They see a discounted property from an institutional seller, they think they're getting a deal. They're not getting a deal. They're catching a falling knife. The institutional investors are using retail buyers as their exit liquidity. They're passing the bag to people who don't understand what's happening. It's wealth transfer in real time from the uninformed to the informed, right? And when institutional investors leave, they don't trickle out, they flood out en masse. And when they flood out, prices will collapse. We saw this in 2008. Institutional sellers create a cascade effect, if you will. They dump properties, prices drop, which forces more investors to sell, which drops prices further. It's a death spiral that can take years to recover from. And that spiral, well, it's already started in Florida. Look at this data. Inventory levels are at a 12-year high. 12-year high. Days on market have doubled in most major metros. Price reductions are becoming the norm, not the exception, and most investors are still in denial because they're blinded by the Florida sunshine and the promises of no state income tax. They're looking at their Zillow estimate thinking their property is still worth what it was in 2022. Newsflash, Zillow estimates don't mean anything when there are no buyers. Now, let's talk about what's going to really get to hurt and how it's going to hurt the most when all of this comes crashing down. First up, the Airbnb crowd. Oh man, these folks are in for a world of pain. They leverage themselves to hilt when buying properties in 21 and 22, thinking tourist demand would never slow down. Problem is, it has. Bookings are down 30% year over year in major Florida markets. Why? Well, because when people's budgets get tight, guess what's the first thing that they cut? You got it, vacations. I know Airbnb operators in Miami who were printing money 2 years ago. Now, well, they can't even cover their mortgages during the slow season. And with insurance and property taxes going through the roof, their margins have completely evaporated. Well, next is the out-of-state investors. These are the people who bought Florida real estate sight unseen because some guru told them it was a can't-lose investment. They have no idea what's happening on the ground. They just see their money statements getting worse and worse and worse. And then you've got the recent transplants, the people who moved to Florida during the pandemic and they bought at the peak. Well, they're underwater on their mortgages and stuck in a state where the cost of living isn't what they thought it would be. But who I really feel bad for are the retirees. They're the ones who moved to Florida thinking they'd found paradise. Well, now they're getting hammered. They're getting hammered with costs that they never budgeted for. Special assessments, insurance hikes, property tax increases. Their fixed incomes can't even keep up. So what happens next? What's going to be coming down the pike? Well, here's my prediction, and I've been right about these cycles more often than I've been wrong. First, we'll see forced selling accelerate. People who can't afford the carrying costs will have to dump these properties. This adds up to more inventory to an already oversupplied market. Second, prices will need to come down 20 to 30% just to get back to reasonable cash flow metrics. That means if you bought in 21 or 22, well, you're looking at significant losses. Third, the rental market will get flooded as all these Airbnb properties convert to long-term rentals. This will drive rents down, making the cash flow situation even worse. And fourth, now this is the big one, municipalities will jack up taxes even more to make up for falling property values. It's a vicious cycle that feeds on itself. Now look, I'm not saying Florida real estate will never recover. Markets are cyclical. But if you're holding Florida real estate right now, thinking it's going to bounce back next year, I'm sorry, you're fooling yourself. This correction will take years to work through. Years of pain, of losses, of negative cash flow. The smart money's already gone. Question is, will you be smart enough to follow them? So let me be crystal clear about what's coming next. Florida real estate is headed for a crash. Not a correction, not a soft landing, a crash. And it's going to be worse than 2008 for one simple reason. There's no government bailout coming this time. In 2008, the government stepped in. They bailed out the banks. They created programs to help homeowners. They did everything that they could to stop the bleeding. But this time, the government's broke. Inflation's already out of control, and they can't print their way out of this one. They can't do it. Florida real estate will drop 30 to 40% from its peak values within the next 24 months. Some areas will see 50% drops, and it's going to take a decade to recover. So let's look at the numbers. When insurance costs triple and property taxes double, that doesn't just hurt cash flow, it destroys property values. Because the next buyer has to factor in those costs as well. The property that made sense at maybe $300,000 with $3,000 in insurance doesn't make sense at $300,000 with $12,000 in insurance. The math just doesn't work. So if you're holding Florida real estate, run the real numbers, not the fantasy numbers, the real numbers. Factor in realistic insurance costs, property taxes, HOA assessments, maintenance, vacancy, real numbers. If you're not cash flowing at least $300 a month after all expenses per door, you're in trouble. Second, consider getting out now while you still can. Now I know that's hard to hear, especially if you bought at the peak, but taking a 10% loss today is better than a 40% loss tomorrow. Pride is expensive in real estate. And third, if you absolutely must stay in Florida, stick to markets that actually have economic fundamentals, not tourist traps, not retirement communities, real cities with real jobs and diversified economies. And even then, I suggest you be extremely selective. Look, I'm not saying Florida, all of it, is uninvestable forever. That's not what I'm saying. Markets will cycle. What goes down eventually comes back up. But we're in the early stages of a massive correction, and smart investors protect their capital first and they chase the returns second. The writing's on the wall. Insurance companies are fleeing, institutional investors are selling, the fundamentals are broken. The only question is, are you going to read the signs and act, or are you going to be another casualty of the Florida real estate crash? Remember, in real estate, it's not about following a herd. It's about following fundamentals. Right now, the fundamentals are telling us to get the hell out of Florida. Now, look, if you got some value out of the video, be sure to like and subscribe and click the bell to get notified when I post new videos. I'll see you in the next video, and you can access it right here.